Let's bring in Ryan Patel, who is the Global Business Executive and Drucker School Senior Fellow. He joined us this morning from the NASDAQ there. Ryan, I know you were listening in there to Christine Lagarde's comments. Your thoughts in terms of the global outlook?
Well, I laugh because she said she's reading the newspaper like everybody else. No, she's reading a little more detail than everybody else. I mean, the global outlook is tied to the trade perspectives. There's nothing you have to go around. There's nothing to go around. I think the China trade isn't on the hot button right now, but it will be when there is no trade deal and the market will react. I mean, we're talking about even New Zealand and China recently having meetings and talking about bilateral trade and having more free trade agreement. And I think that's going to put pressure. I assure you, it's going to put pressure when you see some of these Western countries that they say start to do deals with China. That'll put pressure with the U.S. and other countries, that allies that are left, to be able to do it. And don't forget about Brexit. Like Brexit, and it is going to affect, if it's a clean exit with no soft deal, will have an effect with the global economy. It doesn't matter what country it is.
Ryan, getting back to the China question, I mean, the big question, in addition to trying to figure out what exactly the deal will look like, is what has actually been priced into the market right now. We keep hearing that there's going to be a rally on the back of any kind of deal, and yet if there aren't any specifics in there when it comes to structural reforms and enforcement, how much upside do you see?
Well, the truth answer is there shouldn't be any. The way the market reacts, I'm not really sure. I think, to your point, there needs to be some kind of language that is around the IP protection. That is what the U.S. administration has continued to say, that's what a trade deal looks like. And talking about deficit and buying goods, that's all great, but I think this is what's going to tie into. I think you'll see a pop. You know, my guess is you'll see a pop just because there's a deal that actually is in place, and then you're done talking about it until maybe it happens again.
And Ryan, on the issue of Brexit, you know, you said there will be a reaction if there's a crash out essentially over in the UK. I mean, you look at the impact already. So many of these banks have moved their operations, at least temporarily, to Europe. I'm looking at $1 trillion in assets being shifted over. You talk about car makers like Nissan, who've already scrapped their plans for expansion. Is the market being a bit too complacent in terms of the full impact of a Brexit, whether in fact there is a deal when they exit, or whether in fact this continues to drag on?
You have all my answers. Of course it's complacent. Nobody really, like, the businesses haven't priced in that there is no deal. There's always been some kind of, well, something's gonna happen. You talk about banks temporarily moving. They've already moved to Ireland and Germany. They're not waiting. They can't. They can. And you talk about, even today, Walgreens reported a profit loss. Guess whose Boots is taking a huge hit in the UK with the consumer spending and those perspectives. So we're starting to see it. What is really scary about it is there is no backup plan. I mean, you talk about there isn't any other bilateral trade deals that are already in place if it's a clean Brexit. That's why the soft Brexit is something in the short term. I'm not saying the long term is the best deal for what the UK is doing, but because it's been over 2 years, we're at this point with a deadline. You know, they have to temporarily kind of give some kind of relief. And again, if there is no deal on the table, they got to redo all their bilateral trails. They haven't been able to get it with any of the big economies just yet.
So as an investor, I mean, what's the hedge against that? Is the idea to maybe move away from some of these companies that have heavy exposure in the UK?
I think, there's two folds. One is, I think the companies that haven't had a plan specifically, which they should have, where how they hedge their plan, I wouldn't go away from it. I think there's opportunity, actually. The British economy is actually fairly great, and the pound is actually another opportunity while it continues to take a hit. This might be one of those times where you actually try to get into it. But I think it's the exposure is those who are not diversified and strictly on the EU and the UK trade tariffs, especially with anything to do with customs. And if there's no customs deal to be had, that's going to cost of goods to increase, margins to increase, and obviously profit to decrease. So those are the things that I would probably focus on.
And Ryan, getting back to U.S. equities, Goldman Sachs is out with a new note indicating stocks with the most upside to its price targets, listing companies like PG&E at the very top, DXC Technology, and Nectar Therapeutics. Your thoughts on those stock picks?
It's interesting, right? I think those are sectors. I think it's showing you something that there's a lot of room to grow in each of those things, utilities and like you said, pharmaceutical. I think you're going to start to see why Amazon and some of these other companies are going to get into these places that they can be able to disrupt, because there's a lot of room to grow. The other one that I want to say in there that that was on the list was don't forget about Netflix. Netflix continues to be on top of the list, even if some downward pressure somewhere, they continue to be on that list.
And let's look at the downside to all this, because Goldman did also list some stocks with downside: Juniper Networks, Church and Dwight Company, and Clorox at the top of the list on that front. Your thoughts?
Well, if there's an upside, there's got to be a downside. And, what was interesting on that list was, Clorox, Procter & Gamble was a little bit further down this list. And, a lot of the CPG food product companies, Hormel was on it too, I think. And to me, that's interesting because I think it's time for that space to have some mergers and acquisitions. It's been wanting to do it all last year and it hasn't happened. That space is going to consolidate. My guess is there are going to be some mergers and acquisitions by the end of the year in the CPGs, in the consumer packaged goods space.
Okay, we're going to have to leave it there. Ryan, appreciate your time today. Ryan Patel joining us there from the NASDAQ.